Good afternoon, everyone. My name is Nishant Singh. I head the IR function at Narayana Hrudayalaya. I welcome you all to the Q3 FY23 earnings call of the company. To discuss our performance and address all your queries today, we also have with us Mr. Viren Shetty, our Vice Chairman, Dr. Emmanuel Rupert, our CEO and MD, Mrs. Sandhya, our CFO, Mr. Venkatesh, COO of our Eastern and Southern Domestic Operations, Dr. Nesh Shetty, MD of our Overseas Subsidiary HCCI, better known as Cayman, and Durga Prasad, Senior Manager from the team. We hope you have gone through the investor collaterals which have been uploaded on the stock exchanges as well as our website. As usual, before we proceed with the call, we would like to remind everyone that the call is being recorded and the transcript of the same shall be made available on our website as well as on the stock exchange at a later date. I would also like to remind you that everything that is being said on this call that reflects any outlook for the future or which can be construed as a forward-looking statement must be viewed in conjunction with the uncertainties and the risks that they face. Post the call, should you have any further queries, please do not hesitate to get in touch with us. We would like to address them to the best of our ability. With that now, I would like to hand over the call to Dr. Rupert.
Good afternoon, everyone. I warmly welcome you all to Q3 FY23 earnings call conference of Narayana Hrudayalaya Limited. The third quarter of the fiscal year delivered steady performance supported by the growth in business across our flagship units, newer hospitals, and improvement in payer mix. Consolidated revenue for the quarter stood at 11,282 million INR, reflecting a year-on-year growth of 17.5% and a marginal decline of 1.2% compared to the previous quarter due to the seasonal nature of the business which affect patient footfalls. However, contribution from international patient footfalls remain unaffected. Narayana Hrudayalaya generated consolidated EBITDA of 2,660 million INR in Q3 FY23 at a margin of 23.6% against 22.3% of Q2 FY23 when adjusted for the one-time other income. This margin improvement is attributed to improvement in payer mix and cost efficiencies. Our Cayman unit managed to contribute to the overall performance despite holiday season, and HCCI revenue marginally declined by 3.2% to $28.2 million. We remain optimistic on the robust growth prospects of overseas business in Cayman and continue to explore the investments in surrounding islands on an opportunistic basis. Our overall balance sheet and liquidity profile remains strong with group cash and liquid investments of over 5.6 billion INR against gross borrowings of 7.8 billion, a net debt of 2.2 billion as of 31st December 2022. Our debt to equity ratio has further improved to 0.11 against 0.14 in Q2 FY23, giving us sufficient room to fund our expansion through a mix of borrowings and internal accruals. We have incurred capital outlay of close to INR 6.8 billion, which includes the Sparsh acquisition for 9 months ending 31st December 2022. And in the fourth quarter, we expect to spend the balance amount of guided capex of INR 10 billion for FY23. We have also provided further disclosures in slide 12 of our investor presentations on capex spends for FY22 and expected spend for FY23 and FY24. During the pandemic, we partnered with YouTube on digital awareness program to provide reliable healthcare information on a daily basis. We created more than 600 videos to provide evidence-based answers to questions of YouTube users across India in 6 different regional languages. This initiative, which received 45 million consolidated views and more than 7,000 likes, allowed people to understand their affliction in a very difficult period. We are proud to share that this was featured in Google's Impact Report of 2021, which was released in December 2022. We are strengthening this partnership with channels like YouTube. Our total investments in digital engagements channels grew online traffic by 97.5% to 5.43 million users in the current quarter as against Q2 FY23. We are also pleased to inform you about the soft launch of Atma SaaS version specifically designed for small healthcare facilities such as diagnostic labs, nursing homes, and standalone hospitals. Atma SaaS offers a streamlined integrated solution for an underserved segment of the market scattered across Tier 2 and Tier 3 cities. The team is onboarding foundational customers to gather valuable usage data and feedback to further enhance and refine the platform. Aligned with our vision to provide integrated healthcare to wide sections of the society, we have piloted a subscription program in Bangalore to cover individuals and family members. We have recently crossed a landmark milestone of 1,000 subscription plans and are witnessing continuous traction. These results are encouraging us and give us confidence to roll out a comprehensive, personalized, seamless healthcare service at the doorstep through digitally integrated patient touch points. We will keep providing more information in the coming quarters. We continue to strengthen our current position and grow our brand through several various strategic initiatives that will drive our vision to offer a gamut of integrated quality healthcare services to people across the geographies at an affordable cost. Thank you.
Sir, I would request everyone to now use the raise hand feature to start posing their questions. Mr. Prithviraj.
So my first question is on the new hospitals for the India business. Could you give us the revenue and EBITDA number for this quarter?
Can you please speak up a little bit?
The revenue and EBITDA number for the new hospitals in India business.
So this is, you're talking about the 3 new hospitals.
Yeah.
Okay. So we have been able to continue to improve our performance on the 3 new hospitals. We have, from a revenue growth point of view, just give me a second. The revenue was about 110 crores for this quarter for the new hospitals, SRCC, Gurugram and Dharamshila. This was a 17% growth versus last year. And the EBITDA, which we were able to deliver was, just give me a second, 9.3%. This has, in this, the Mumbai hospital is almost broken even, and Gurugram and Dharamshila are positive. So that is the number for the new hospital.
Thanks for that. See, this 9% EBITDA margin, is actually quite a good improvement compared to what we have seen over the last few quarters. So, how long will it take for this to reach your sustainable EBITDA margin of, say, 15-17% from now on?
I think for Gurugram and Dharamshila, we are almost there. So I think by, as we see the next few quarters, we should be able to reach a reasonably sustainable margin for Gurugram and Dharamshila. Mumbai, we are breaking even. We have broken even actually in January as well. So Mumbai will take us maybe more than a year, but we are in that direction. But Gurugram and Dharamshila, we are almost there.
And my next question is on the Cayman business. I guess in interview you mentioned that the oncology department will be commenced from Q1. So how much is the capex that went for this particular block, and what kind of revenue potential are you looking at?
Yeah, hi. Oh, sorry.
Cayman, sorry. Go ahead. Anil.
Is this Cayman or Jaipur? I'm sorry.
Cayman,
This is Cayman.
yeah. Cayman.
Sure. Hi, Prithviraj. Thank you for the question. The last slide of the investor relation presentation talks about the capex we've incurred and we project to incur. I would say about 80 to 90% of that is for the new oncology block, which includes not just the oncology block, but the new hospital as well. The new oncology block, yes, you are right. We are on track to treat our first patients from Q1 of next year, early Q1. So hoping April, hopefully, we'll be starting radiotherapy services in that. Since it is a department, essentially a service line for us, we won't be in a position to share specific revenue projections for a particular department.
That's helpful. Thanks.
Thank you. Next in line for the question is Dhara.
Yeah, thanks for the opportunity. I had two set of questions for Cayman. So despite the declining number of discharges from last 4 quarters, our average revenue per patient has actually increased for Cayman. So what is the driving factor for this?
Hi, Dara. Thank you for your question. So we will, there are a few reasons for that. So the first is essentially an increase in the complexity of patients that we continue to treat. As we commission more service lines which are catered towards our oncology offering and getting ready to ramp up the linear accelerate and the comprehensive oncology program, we are going to be doing more and more complex patients. The second reason is the discharges, which is the denominator for the ratio you are referencing, as well as the discharge is an absolute number. We had a migration of our core EMR system from the legacy system to Atma a couple of quarters ago. So Atma is more sophisticated in that we are able to break down discharges into more granular details of daycare, emergency, and regular IP discharges. So the investor relation team will be releasing more details on how we have to reconcile the pre-Atma and post-Atma discharge numbers for this, maybe in a quarter or two.
So if the new oncology block you're saying will be operational from Q1 FY24, so should we expect that the number of discharges will also grow from here on?
So the oncology block, which will be ready from April, will be only offering radiotherapy. We continue to offer medical oncology. We have been offering medical oncology for a while, and that will continue. Surgical oncology will build up as well. So radiotherapy, the number of discharges, these are predominantly daycare patients, so they will not be inpatient discharges. And although the realization is high, and we expect the margins to be commensurate with what we are earning, the number of patients will not be very significant to move the needle in the early days. That will take some time.
Okay, sure. That's answered my question. That's it.
Thank you.
Thank you, Dhara. Next in line is Arsh.
Hi. So my question is so there was this EBITDA margin that was given in the previous investor presentations. From what I have, the previous quarter, Bangalore was around 35%, East was around 40%. So could you possibly provide me the breakup for this quarter?
Actually, we are kind of aligning to industry here.
Okay.
And I think also our units are getting matured. So we are now stopping that. Earlier we were providing that distinction because different stages of maturity was there for different geographies. Now we more and more we want to align with how industry represents data. But what we will continue to do, like we did at the beginning of the call, is we will provide information on our new hospitals, revenue and EBITDA, until they come to a state where they are a steady state and they are able to make run rate returns. Until then, we will provide that data in the investor call. But we believe that time has come that we don't need this distinction between regions. They are more or less consistent in terms of performance.
Sure. And just one follow-up question. So the ALOS, average length of stay, has been consistent over the last few quarters. But there was a lot of talk about robotic surgeries and other things. So is this expected to reduce the average length of stay going forward?
Yeah, the robotic surgeries are all, when you compare to the overall number of discharges across the group, the number is the number is small to make a major difference. While, however, we are continuously working on operational efficiencies and trying to reduce the pre and post procedure length of stays. And that is what, when we had given some kind of a guidance level, we said that over 6 quarters, we'll try and bring it down to around 4.1, 4.2 kind of a thing.
Sure. Thank you.
Thank you, Arsh. The next question is from Mr. Ashish.
Hi, thank you and congrats for a good set of numbers. I had a slightly question from a medium-term perspective. Given the fact that we are spending 2,000 crores capex between this year and next year, which is basically doubling our current net block. So let's say, how long do you think it would get the new capex will need? And a lot of it is brownfield. So how long do you think it will need to get to, let's say, a 20% plus ROC on the incremental capex? Would it be a couple of years or faster? What's your thought process around that?
Ashish, it'll take a couple of years. The construction itself, given that some of this is in running hospitals, means that the work goes half as quickly as it would in a greenfield setup. So 2.5 years on construction. Break-even time should be faster because you're leveraging. I mean, they may not be break-even time because you're using it within the existing manpower and so on. But definitely in terms of returning positive EBITDA, that would take a couple more years after that. So
FY26 would be fair to look at it?
It's a good ambition, but could extend beyond that.
Okay. When you said return means a 20% kind of an ROC on incremental investment.
Yeah.
Okay. Would Cayman be faster because the fact that it's an oncology block and the construction is getting over for large blocks very soon?
Viren, should I take that?
Yeah, Anish, go ahead.
Yeah. Hi, Ashish. Yeah. So the Cayman capex will be, like you said, is phased. So oncology, which is a small portion relatively, about 10% to 15% of the total capex will be incurring. That will be ready from March onwards. It's the only radiotherapy facility in the country, so we don't expect any ramp up phase for that. It will be active from day zero, and we expect that to be just like any other service line from the beginning. The larger hospital, which will be ready, will naturally, it's a separate campus, it's a separate location. It's not, we're not spending this within the same campus. Having said that, it is the same island and it is a small island. We don't have a specific number to share as to how many months it will take us to break even. But as I mentioned, it should be quicker than going to a new location and starting from scratch.
Sure. And secondly, Anish, in terms of Cayman, in the past we've talked about business from new islands. What is happening to that now that we are post-COVID, or do you think that's something which will still take some time?
Oh no, definitely. So, since the travel restrictions, so one was post-COVID, the other one was the island opening up completely. So as we discussed during the last few calls as well, all those restrictions are, there's no longer any restrictions, and it's been that way for some time. So we are seeing a lot of the Caribbean channels that we were working on for many years open up. We are seeing a steady growth and return to normalcy in the overseas patients we're getting from the other Caribbean islands. And that's going to be very, very helpful as we ramp up the radiotherapy facility as well, because this is, there aren't too many equivalent facilities in the region. Having said that, as of now, the local patients constitute the bulk of our business, but we're seeing very positive signs with some of the overseas markets. These are patients that come to us, just through us soliciting them, whereas others are activities where we go to other islands for different levels of engagement to try and attract patients back to Cayman.
Sure. And in terms of capacity utilization, where are we currently on the current facility on the IP side?
Could you repeat that, please, Ashish?
Where are we currently on the capacity utilization?
Sure. So the facility has 107 beds, and as we've said in the investor presentation, I think this quarter we're a little over 55 beds in occupancy. We have adequate capacity to treat whoever needs to come. And, there are days when we have, shortages in certain critical infrastructure, but on the whole, we're very comfortable with treating incremental business. And this will line up well with the new hospital, which should be commissioned according to our previous guidance, which will significantly increase our capacity across all classes.
Sure. You are not expecting a step up jump as the islands completely become open in terms of the other islands. So 70% plus kind of a utilization on the existing capacity.
It will happen, but it will not happen suddenly because, like we discussed a couple of calls ago, when Cayman had to shut down, essentially, people in other markets, they didn't not go anywhere. They had to diverge and go to other markets that were willing to take them. So swinging those channels back to us is a gradual process. It definitely won't be, and for clarity, all islands are open completely right now. Nobody has any restrictions. So, it's not going to be a sudden jump up, as you had guessed. It will be a gradual movement that will take time, and that works, perfectly fine for us because it helps with the phasing out towards the new building.
Sure. Okay. Thanks, and wish you all the best.
Thank you.
Thank you, Ashish. Do we have any further raise of hands? Yeah, Gagan, please go ahead.
Good afternoon. So the first question is on the gross margins. From Q1 to Q2 and then to Q3, gross margins have consistently improved. What is the sustainable number for gross margins as we go ahead?
I think the current number is sustainable, we believe. The reason you are seeing the improvement is also because we've been able to do more with the current capacity. But yeah.
I'll answer your question, Gagan. This is Venkatesh here.
Yeah.
Yes, you have seen correctly that the gross margins have been improving quarter-on-quarter. What we believe is that we can sustain these margins. Primarily what we have seen last year, we had COVID on the baseline, so the consumable cost was always high. But now that COVID is not there, we've been able to work out savings in relating to that part of consumption. And plus we have worked very hard with the supply chain to bring about further improvements in the consumption area. More than that, we have also worked very hard in terms of improving our throughput so that we could utilize our existing capacity to the optimal. So what we have done is we have focused more on doing daycare, cardiac procedures and robotic procedures which are better throughput with the morning admission, evening discharge. We're also working on adding operation theaters, ICUs, diagnostic and lab setups so that we can process more and add more volumes within the existing capacity. We've also invested significantly in technologies to improve our throughput, say faster discharges, faster lab results and so on. And it has actually shown results in terms of 17% reduction in the turnaround time for lab investigations so far, and even 36% of the top 5 investigations. If you see, 25% of all our consultations are all through appointment channels, and 80% of all our appointments are done through NHCare app and portal. We also worked on increasing throughput through process transformations, improved on our discharge efficiencies, and also working on reducing air loss, which you will see the results in next quarters to come. So what has happened is all these throughputs have helped us increase the revenues in the same capacity with the same cost in terms of overheads and manpower, and that's where we have been able to squeeze higher margins quarter on quarter. Unless there is any unforeseen headwind, this is reasonably sustainable.
But a couple of the headwinds, which we'll have to also keep in mind, is that drugs will come under the price control. More and more of the consumables could also come under price control. A lot of the high-end implants, there is talk that the government may reduce the price of stent even more than what it currently is and add more items to this. We're in a very competitive field. Doctors and nurses are always, have good job opportunities in other centers and in other countries. And so we consistently face a lot of challenges on the payouts. So we're doing all we can, and we believe where we are is sustainable, and we're working towards improving this, but that also gets tempered against the other massive challenges this industry faces.
Yeah. Thanks for that one. Second question, is around simply trying to understand that before all of the capex that you're doing reaches fruition, how much headroom do your existing Indian facilities give you to grow? I'm not looking at what growth you can get. I'm looking at the limit, the theoretical limit of what can be the potential maximum outcome of whatever you have, basis tweaking and creating efficiencies.
For some of the larger format hospitals that we have, as long as we're able to put in smaller investments in just realigning the rooms, doing up the interiors, adding new machines, there will be no theoretical upper limit. You can keep growing at high single-digit revenue line because there's enough space to tweak around. But that is true only for 3, maybe 4 of our large hospitals. The rest of them, which are smaller, they're not as well built, you may not have enough room to upgrade, so they will reach a point of stagnation beyond which it will, you just either have to invest or you have to just add and upgrade more capacity or go somewhere else. So the largest flagship units have no theoretical upper limit for how much you can keep tweaking to improve the performance. And that's true for most large hospitals across all the other groups.
Okay. So the reason I asked that is, given that there is adequate demand next year and thereafter, would your capacity suffice to grow at a double-digit rate?
With the exception of our Arctics unit in Calcutta, which is extremely capacity constrained, double-digit growth, we don't want to get into the forecasting game. We will do our best to sustain this growth momentum, and there are other avenues that we would try. But until the new capacity comes, it will be a little challenging.
Right. And since you mentioned the new capacity, 2 questions there. One, in terms of bed strength, what does it add for India? And second, in terms of funding, year to date, you managed to keep your gross debt very stable in spite of almost 700 crores of capex. How should we think of the funding part of the capex as you go into the second tranche of that capex?
The bed capacity part, I'll answer quickly, then I'll hand it over to Sandhya for the capex spend. See, we haven't finalized the drawings for the new expansion that's there, and the bed capacity, once we do it, will come modestly. But like I said, we can't keep measuring the performance and our utilization just purely on beds and occupancy. There is a lot more of investment that we'll be adding on procedure rooms, on OTs, on outpatient areas, patient amenities that will be a spend, can improve realization, but not necessarily count towards the total bed strength of Health City or Calcutta. But having said that, once we start finalizing these things, we've indicated the amount of spend over this year and next. And as and when the drawing gets finalized, we'll indicate that, okay, at this particular time, this will get operational and how many beds will get added to the total capacity.
On the net debt situation, currently our net debt is about 250 crores. Gross debt by the end of the year, we will be around 859 crores. Next year, another 1,000 crores we are planning to invest. I think 500 crores we will invest from internal accruals, 500 crores we'll borrow. So we keep our liquidity profile constant between the years. So our net debt will be around 500 crores by next year end. So that's the aspiration with which we are working. Of course, the situation depends on what choices we make and how it progresses, but this is the broad direction.
Right. Thanks. I'll get back in the queue. Thank you for answering my questions.
Thank you.
Thanks again. Next in line is Mr. Sameer.
Hi, thanks for this, and good afternoon, everyone. The first question is on the payer mix for India business. So the scheme has been coming down steadily now at 20%. So what's the outlook over here?
So we don't have a specific outlook per se on the scheme. We do want to keep a moderate balance of scheme and other payers. The larger philosophy with which we've been working is that if there is an ability if the patient does not have an alternative place to be served, we are serving those patients, and we will not moderate schemes in those hospitals at all. I think where we are right now will be consistent with where we believe to be between 20 to 22%. That will be the range in which I think we'll continue to be. It also depends on how the government looks at these schemes. We've been making continued representations both in terms of the collection issues that we constantly face, as well as in terms of the rates which have not been revised for a long time, and they're not very economically very viable. So we've been making a lot of representations. So if there are some outcomes that come out of those representations, then we will be able to work better with these schemes.
Okay, got it. But what you're saying is, bottom line, that as things stand, you would maintain it at current levels, 22%.
Broadly, yes.
Okay. Okay, so that's what gets me to my next question, that what are the drivers for ARPOB for India business going forward? I can see that, it's been in 12 to 12.5 million rupees for last 4 quarters. So where does it go and what are the key drivers for this?
Sure. So ARPOB, like you are aware that we don't, price is not a significant lever that we exercise. We exercise cost levers to drive efficiency. So to that extent, pricing will not drive ARPOB. ARPOB will come because of mix upgrade going to higher quaternary procedures, as well as improvement on the payer mix. So you will only see and throughput, like what Venkatesh explained, that we are continuously working on improving the throughput. So you will see a gradual improvement in our ARPOB. You will not see a significant jump in the ARPOB. But I think we will be able to manage the overall P&L even with a gradual improvement in the ARPOB. That's how we look at it.
Okay, no, that's very clear. And one final question from my side, and that's for the Cayman Island. Just thinking about it, is there a demand issue over there? As in, what would take your discharges and the inpatient volumes up with the current, facility? Or it is also about the mix issue, that what you can do, which specialties you can do, which you can't, and that will get addressed when you come up with a new block. And we can just talk about that.
Hi, Samir. So for now, for the foreseeable future, the reason, there is scope to improve our number of discharges and procedures by adding services we don't currently offer, or we offer in a very minimal capacity. So as you are aware, recently we announced an acquisition of a very niche ENT practice, which is one of the highest volume practices in the island. So there are certain niche areas like this, along with the broad specialty of oncology, which we do not offer. That will definitely help us see some improvement in the volumes of discharges that you mentioned. Having said that, there are also certain specialties which we do offer where there are other players on island, where we do have market share to gain. A lot of this will be driven primarily by location. So our location is we're disadvantaged by location. Although we have a massive campus, it's very far away from where most of the people live and work, whereas some of the other players have more central locations. So this will be neutralized with the new hospital in Cayman Bay. So that will lead to we expect that to lead to a further volume gain in specialties we currently offer, but where we do not have a dominant market share simply because there are other players. And of course, eventually it is not a very large market. We will reach a stage which is your first guess, where, at a time there will be a demand issue. And our hope and, our aim is by that time for the overseas patients to start kicking in significant levels to move the needle to drive the next level of growth. I hope that answers the question.
Yeah, sure, Anish. That's very clear. And just on the new facility, what would be the tax rate? And I'm jumping the gun, but just to understand that.
I'm sorry, did you say tax rate, Samir? I didn't hear that.
That's right, because I think that for the current business, the tax rate is probably minimal, right? So would that continue for the new facility as well?
Yes, no, not just us, for anybody. The Cayman Islands is a zero tax jurisdiction for business tax. So there is no applicable taxes.
Okay.
Business taxes, yeah.
Yeah, just wanted to make sure. Okay, great. Thank you.
And just for clarity, that's not a concession that is time bound. That's for everyone operating there.
Yeah, sure. Got it.
Thanks, Amir. Any further raise of hands? Any further questions?
Yeah, Gagan, go ahead.
Yes, Gagan.
Yeah, thanks for the follow-up. The Bangalore new orthopedics facility that you acquired last quarter, if you could update us on what's the status there. I think last quarter you indicated that it gives you headroom to transfer the orthopedics cases from your current Bangalore facility out, and therefore creates that much space for you in terms of bed capacity. I mean, are we going to see that sort of playing out in the coming year, or is that something that can happen later? And what's the status and evolution of that one?
So this Sparsh which we started operations in October, and it is being merged into our current operations of the Health City in Bangalore. We have been able to have a smooth transition in terms of the operations in Sparsh with the least hiccups. Most of the doctors working there have been taken into our roles, and they're working with the same energy and vigor which they were doing when they were a part of the Sparsh. So to start with, we are continuing to work with these doctors and also trying to aggressively source clinicians into the system. We've already gotten 3 surgeons and an anesthetist on board, including the clinical lead for orthopedics and trauma. As of now, we've done reasonable numbers in terms of joints and other procedures in this quarter. And this quarter, in fact, has generated a very good EBITDA of around 30% in this quarter, which is much higher than what we had forecasted. Of course, we've got the first objective is to maintain the same performances in this next quarter, and also to make sure that we've got aggressive plans for growth of this particular unit in the subsequent year with higher top line volumes and more EBITDAs.
And on the margins that you used to give up to the prior quarter segmentally or at least city wise, I think cluster wise margins is standard reporting for most hospitals, be it Apollo, be it KIMS, everybody reports cluster wise operating margins. So when you say you want to align your practices to how the industry does it, the industry does report it in that way. So why, I mean, have you discontinued the practice? And I mean, if you could give us some idea, as the previous gentleman asked, in terms of understanding the margin evolution by cluster.
So, from how we've looked at competition and what disclosures, I think most of the focus is on overall margins and the various levers that enable to judge performance better. So we are aligning to that. As we go into future quarters, we will try to publish more data points, which gives, like this time we have put a separate slide on the capex across different types of capex that we'll incur, so we can give more visibility to how our future spends are. So we will try and create more data points that helps you understand the underlying strength of the business. We will also share some of the new hospitals where the margin profiles are low. We will share that information in the investor call so that clarity is there on the improvement plan. But otherwise, we believe that as a group, if we are able to share overall margins, that's a reasonable well indication of where we are headed as a group. And this cluster-wise margin information is not enabling any better decision making than with the data that we are already sharing. So I think we would like to align to that model.
Right. And between Sparsh, Mumbai and Dharamshila, is there, I mean, you indicated there still is room to increase efficiencies with scale, which would mean, as you head into FY24, there's still room to improve operating margins. Any assessment of first of all, the viability of this assumption, and two, a ballpark scale of what could be possible margin improvements because of this?
Sure. So Sparsh, I think, is already around our ballpark margins, like Venkatesh had shared. And so we were talking about Gurugram, Dharamshila, and Mumbai, which are the new hospitals. Like I'd mentioned earlier, Gurugram and Dharamshila are almost there. I think they will get to reasonable margins, double digits. Dharamshila is already in double digits. So we will get to double-digit margins for Gurugram and Dharamshila in next couple quarters. We should be able to get there. Mumbai will take a year. We will turn EBITDA break-even positive also in the next quarter or so. But it will take time, maybe more than a year, to get to a double-digit type margin profile.
And on Cayman, how should we think, in terms of growth for the coming year, with the addition of the radiology department, and also when does the new hospital become operational? Any timelines of when it becomes operational, and when do you see a reasonable sort of occupancy in that one?
Hi, Gagan. So to your first question, I think for the past few years, we've been able to demonstrate, adequate double-digit revenue growth from the existing facility and the existing service lines. So, even without the radiotherapy facility being taken into consideration, we don't see that stopping, at least for the next year. Having said that, adding the radiotherapy facility does add a comprehensive, oncology offering, which will definitely help a lot. To your second question on the new hospital being commissioned, so currently it's well under progress. Timelines are, dependent on a lot of externalities. We currently estimate, and I think this was shared a while ago as well, it won't be commissioned in the coming financial year. I think the time we'd be looking to complete the facility and get all the licenses and accreditations in place will be somewhere in the range of about 14 to 16 months from today. So that's we're still, given how far away we are from that, that is subject to be changed, and we'll keep you posted every quarter, but we expect that to happen in that time frame. And adding on to even Sameer's question, we think that will be a big positive win for us, simply because it neutralizes the location disadvantage that currently hampers all specialties that we offer.
Thanks for that. Just one final question, and this is more to get your opinion on observations around cataract surgeries. Just a case in point to drive home a bigger point, which is that if I look at the cataract surgeries done, the data that's put out for this year, and if I look at what used to be the pre-COVID trend, my assessment is that from pre-COVID, it went down very sharply, less than half, maybe even worse. And then this year, it came to more than double of the pre-COVID levels, which is basically, a lot of pent-up cases getting done. And if you look at the monthly data, it seems to be normalizing. If that is the case with a lot of elective procedures, as you get into the next year, not necessarily only NH, but, for the entire industry per se, case mix would normalize, which would I would think, put pressure on ARPOBs, because this has been a year of exceptional case mix. If that observation can be extrapolated to other elective surgeries. So what's your thoughts on that?
Yeah, it might be very difficult to extrapolate from an ophthal practice, because ophthalmology in general, especially the cataract surgery, is well covered. And the COVID, definitely, it was considered as an elective non-emergency case, so most of them were postponed. And that is bound to jump up and then normalize over a period of time. But if you look at almost every other specialty in the country, we are still significantly underserved in terms of number of procedures that needs to be done vis-a-vis the population and the patient mix. So there is, what has COVID done is it has brought significant awareness of health to the public, irrespective of the across the entire socio-economic zones. So we are quite positive that the awareness will keep pushing the relevant specialities to do certain numbers. And even if you look at the kind of need that is required in the population for cardiac procedures or onco procedures, we are way behind schedule of what needs to be done. So looking at that, I'm sure we may not be able to draw parallels between ophthalmology and the rest of the specialities, but certain specialities may catch up at some point of time. But we are, from whatever 12 months data we have seen fairly good inflow of patients to most of the specialities.
I'll put it another way. People that have health problems in our country, most of them don't know they have a problem and will suffer from it for years, and then eventually, it will end them. For the people who know they have a health problem, very few of them will actually get help for it. Of all the people who try to get help for a problem, very few of them will go to the right place for that kind of help. And of all the people who go to the right place for the help, very few of them will come to us. So in terms of the opportunity set, you're talking about many orders of magnitude between what startups like to call a total addressable market versus the number of people that we are currently treating. So COVID or no COVID, the growth of patients with health problems into tertiary and quaternary care, super specialty healthcare facilities like ours and comparative hospitals to ours, has huge opportunity. And that those generally form the first one or two decks that every hospital likes to put out. Now, how we get there is through all the activities that we're doing on improving our efficiencies, improving our reach, going all over the place, increasing awareness, investing in digital branding to tell them that, a heart problem should be taken seriously, get the checkup and so on. So that's how you build the awareness and reach out to patients who otherwise are not consumers of healthcare, which is not the case for Opthal because we're very well served and most people understand.
Yeah. Thanks for the detailed answer. I'll get back in the queue. Thank you.
Thanks again. Now we have Nitin next in line to have the Nitin, please go ahead.
Thanks for taking my question. I have just questions on the capex. So two things. One is for the current year, how much capex have we done so far for the 9 months?
6.8 billion.
And in terms of the pending capex, about 300 odd crores, which is there for Q4, what are the areas where we're looking to spend money on, invest the money in?
So, like we've indicated in the slide that we have shared, there are 4 chunks in which the capex is getting spent. There is a part that is the part on the Sparsh, etc. are done. There are certain we had a lot of pent up demand on our replacement of the biomedical equipments, etc. And also there was a lot of civil upgrade that we were working on. We have spoken about it in our previous investor call. So almost 35% of the investments that we have made and are going to make through the balance remaining part of the year is going into replacements and maintenance and upgrade. In addition, about 13% of the investments that we are making are going into new capabilities, setting up, new cath labs, new oncology blocks, those kind of items. So that's about 13% in the current year. And of course, you are aware of the Cayman piece, which is about 30% in the current year of our spends are going into Cayman and about 20% into the Sparsh acquisition that we did. So that's how the 10,000 crores is split. And this data is also there in I think in slide 12 of the investor deck. So in that range only it will get spent, mostly towards the biomedical equipments and the work that we are doing on the civil side. The balance remaining 3 months.
And we have a sum of 350 odd crores which we've outlined for capex for the next year towards upgradation. And so are there any specific facilities where this investment is being done?
It's very spread out across all our hospitals. The bulk of it will be going towards Calcutta and Bangalore. to our large hospitals, but the rest towards all of them, Jaipur, Ahmedabad, Jamshedpur, Delhi, those places.
And where on Calcutta, since you mentioned, how are we now looking at the capacity constraints there?
We have no choice but to look for land to buy something and set it up. The only other option otherwise was to demolish one of our old towers and rebuild it, but that would cause too much disruption of the operation, so we don't want to consider that right now. We found a few land parcels. We're, trying to acquire them, but buying land in West Bengal is always difficult, so it's taking time, but we're hopeful that it should happen sometime next year, and then we can start construction immediately.
But then there's still going to be another 2 to 3 years before this new facility comes up.
Yeah.
How are we looking to handle the Kolkata, capacity constraints in the meantime?
The Howrah Hospital construction is ongoing, and that should get operational. When that is complete, it will take some of the load. It won't. Arctics will still have some challenges. We'll do a little bit more realignment there, try to take over some buildings nearby on rent. We've taken over some of the apartments nearby to convert them into our purposes, move admin, redo the parking areas, and so on. Little things that we can do, but won't change the needle too much.
Okay. And just another, Anish, what is the total capex you're looking at in Cayman for this new expansion and is it still sticking to the $90 to $100 million we had talked about earlier? It's going to be lower, higher than the previous estimate?
Nitin, I wish it was lower. No, we're still on track for that. The exact values have been broken up in, I think, one of the last slides of the investor presentation, converted to INR, I think. So that's detailed there, but we're still on track for the earlier guidance.
Okay, thank you.
There may be some slight upward revision, but nothing significant.
Oh, thanks very much.
Thanks, Nitin. Next in line, we have Mr. Prithviraj. Please go ahead.
Anish, just one question on Cayman. See, given that oncology department will be operational from Q1, do we expect margins to take a dip initially, or can we sustain this 40% plus EBITDA margin in Cayman?
No, we don't expect any margin dilution because oncology. So what we are adding incrementally is radiotherapy, which is capital intensive, but from an EBITDA margin perspective, very very healthy and definitely accretive to what we're doing. So we don't expect any margin dilution.
Okay, thanks.
For this phase.
Yeah, for this when I'm talking about only the radiotherapy facility, which will be ready in a few weeks, only for that phase. When the new hospital is commissioned, that's essentially commissioning a new building. We'll be duplicating a lot of our fixed costs, unfortunately, in a completely new location, etc. So, and as we've guided before, they most definitely will be margin dilution at the time.
Yeah, that's helpful.
Thank you, Prithviraj. Yeah, next we have Mr. Nitin again. Nitin, please go ahead.
Sorry, I'm done. I forgot to raise my hand.
Okay, so do we have any further questions, anyone? All right, so if we have no further questions, we would like to conclude our session. Thanks everyone for your active participation as always. Please do feel free to reach out to us in case of any further questions. Thank you once again from all of us.